Hello. In this video, we'll continue with characterization rules and we'll focus on section 1231, gains and losses. Now, please recall that in order to have long-term capital gain treatment, we must have first, a sale or exchange, second, a capital asset, and third, the asset must have been held for more than a year. The holding period is more than a year. And that gets us long-term capital gain, which is preferential treatment. Sale or exchange is a general principle, sale being conversion of property for cash, exchange being property converted for other property that is materially different. Capital asset has a specific definition that all assets are capital asset unless otherwise specified, and the code carves out about 8 to 9 different definitions of what's not considered capital asset. Finally, to be long-term, the property has to be held for more than a year, and we take into account special holding period rules. If we get all that, we get long-term capital gain if there's a gain, or long-term capital loss if there's a loss. But if it's long-term capital gain, then it's preferential rates, which are taxed historically lower than the ordinary income rates. This is good for the taxpayer. We want this. Now, let's say that you have long-term capital gain treatment under the normal rules, under the sale or exchange, capital asset, or long-term. It's possible that there are specific carve-outs throughout the Internal Revenue Code that say, yes, you meet these criteria, but because the transaction is a specific type, a specific area, we're going to take it out and it's not going to be considered long-term capital gain, could be considered ordinary. Various anti-abuse rules or policy are behind those rules. Now, on the flip side, let's say you don't have a sale or exchange or a capital asset. Well, if you don't have those items, it's possible you can still get long-term capital gain treatment. And that's what Section 1231 is all about. It's one of the carve-outs that Congress has enacted that allows it's possible to still get long-term capital gain treatment even though a specific transaction doesn't have a sale or exchange or doesn't have capital asset, or maybe it's sale or exchange but doesn't have capital asset, or opposite, or it's a capital asset but doesn't have sale or exchange. You have to have that long-term, held for more than a year. You're going to see that is going to be the item that's very important. So understand that. Section 1231 is all about some transactions fail the sale or exchange requirement, but they still can be capital under specific circumstances. We're going to go through that. You see all this stuff on the page right now. We'll go through all of that. You can have a sale or exchange, but you might not have a capital asset. There's specific, again, instances where you can have long-term capital gain without capital asset, but you do have a sale or exchange. Or you fail both of those. You don't have either. Again, specific instances. So when academics and teachers and whatnot, they talk about Section 1231, a lot of times students get very confused. Very confused about 1231. 1231 is a very mechanical provision, and it does get tough because there's a lot of stuff going on. My job is to condense this as easy for you to understand and also as quickly for you to understand so you can go back over this many, many, many times. What I recommend right now is pulling out a blank sheet of paper and writing down what you see in front of you, but we're going to go in order. So writing it in order and doing it multiple times. Doing it multiple times. Okay? Also, I want you to remember sale or exchange, capital asset, and long-term holding are the normal rules required for long-term capital gain. The reason you have to understand that is because there's going to be specific things within Section 1231 that allow you, again, to get long-term capital gain potentially without having one of those items. Congress is going to supplement that for other things. Okay, so Section 1231 is broken into two parts. What we call the main Hodge Pot and the sub-Hodge Pot, which is also known as the fire pot. What is a Hodge Pot? Well, a Hodge Pot is really just this mechanical device that allows us to put certain gains and losses together to determine the outcome, which creates a characterization aspect. Remember that in tax, there's really two types of characters when it comes to gains and losses. There's capital and there's ordinary. When we have gains, we prefer capital, long-term capital, because the preferential rates. When we have losses, we prefer ordinary because there's not as many limits on ordinary losses compared to capital losses, and also because the tax benefit, the reduction of a loss against gain, is better for ordinary. Okay, very important to understand. So we have the main Hodge Pot and the sub-Hodge Pot. So when you think of the Hodge Pot, think of it like a place where you're going to put a bunch of gains and losses, specific gains and losses during the year, and you're going to come out with a net number. It's all about netting. Whenever you see the term Hodge Pot, it's all about, in your mind, you should be thinking, okay, I have to net certain things. I have to net. I have to add and subtract certain things. Netting is what Hodge Pots are all about when it comes to mechanics. Hodge Pot, think netting. Okay, so the main Hodge Pot is the first Hodge Pot we have in 1231, and the sub-Hodge Pot, also known as the fire pot, is the second Hodge Pot. We're going to start with the sub-Hodge Pot because you're going to see, it's very important, you're going to see that the sub-Hodge Pot potentially can flow into the main Hodge Pot. All right, so the first requirement in the sub-Hodge Pot is that there must be an involuntary conversion. So there must be an involuntary conversion. Well, what is involuntary conversion? Involuntary conversion includes theft, natural disaster, condemnation, eminent domain. So if someone steals your property, or it's destroyed in a hurricane, or the city condemns your house or building, or it eminent domain, it takes your house to build a highway. These are all involuntary conversion. Involuntary connoting that there's no voluntary nature. Now note that to have long-term capital gain under the normal rules, we need sale or exchange. Sale or exchange is a voluntary process. Sale for conversion of property for cash, exchange property for property. Those are both voluntary. Involuntary conversion, though, is not sale or exchange. So right there, we're getting the potential by having this involuntary conversion requirement. So that's the first element. If we have involuntary conversion, continue. If not, if you don't have involuntary conversion, we'll go to the main Hodge Pot. You might be able to get it, okay? You might be able to go to the main Hodge Pot. But right now, we're at the sub-Hodge Pot, so let's look at this. And when you do section 1231, you got to look at both of these. And we're looking for all transactions throughout the year. This applies all transactions for the taxpayer for the year. All transactions for the taxpayer during the year. We look at all, not just with respect to a specific transaction. Look at all transactions the taxpayer had during the year. Did the taxpayer have any involuntary conversions? If so, we continue. Okay? The next part is one specific requirement that deals with the property type. The property. Okay? The property. You have to have specific property. You have involuntary conversion, has to be specific property. So the first one is trade or business real property. Trade or business real property. The second one is trade or business personal property that's subject to depreciation or amortization. That's amortization. That's amortization. Now notice I put number 2, number 3 here. Do you remember where that's from? You're probably like, that seems very familiar. I saw that in your other video. I saw that in your capital asset definition. And you're exactly correct. When we talked about capital assets, the way that the Internal Revenue Code defines capital assets is it starts off saying that all assets are capital unless otherwise specified. And we first started saying inventory is not capital. What was next? What was number 2? Number 2 was trade or business real property. Number 3 was trade or business personal property subject to depreciation or amortization. So if you remember, real property is the land and any property attached to the land. So that's buildings, fixtures, fences, anything that's attached to the building. Those are all considered real property. Personal property is everything else. So real property has to be tangible. Personal property can be tangible or intangible. Now, to get this specific item, has to be trade or business. So if you recall, when we talked about the big 3, when it comes to deductions, we have trade or business, investment activity, and personal activity. We have to have trade or business. It has to be trade or business in nature. Please see the discussion about what exactly trade or business is in the deduction videos if you need to go back and talk and learn about that. So trade or business, real property, trade or business personal property subject to depreciation or amortization, or a capital asset. Capital asset. Those are the 3 possibilities. 1, 2, 3. And note that they all are or, right? They're all ors. You can have any of these. Doesn't have to be all 3. It's any of these 3. Okay? This is the type of property. If we have any of these, we continue. So it has to be involuntary conversion. Trade or business real property. So let's say that a business owns a building, a factory, and it's destroyed in a hurricane. Well, the hurricane destruction is involuntary conversion, right? And the destruction in the building is trade or business real property. So right there we met that. Or it could be equipment, trade or business equipment that was destroyed. Or capital asset. Capital asset. It could be destruction of some art. So a piece of art that's owned in the trade or business would be considered a capital asset because it does not meet any of the carve-out exceptions of being a capital asset. So it would be a capital asset. Very interesting, okay? Unless you're holding the art as inventory, which that's not the case. We're talking about some very expensive art here. So we have involuntary conversion. We have property. Again, it's any of these three possibilities. Now next, so we have the property, right? We have property. We have one of these three. Okay, one of these three items. Next, the property has to be held for at least a year. So remember I told you that the long-term nature, that always has to be there regardless. To get long-term capital gain, you have to have held the item for more than a year. That's regardless. Okay? So we've held the property for more than a year. We continue. So if we have those three things, we have involuntary conversion, we have some type of property that qualifies in the three specified that I mentioned, and then it's held for more than 1 year, then we put the gain or loss from that transaction. So it's the amount of money received minus the adjusted basis. That gives us our realized gain or loss. Then we calculate the recognized gain or loss. That recognized gain or loss goes into the fire pot, the sub-Hodge pot. We put all fire pot gains or losses during the year. So let's say a business had a bunch of property destroyed from a hurricane and then it had a theft of some other property. We have a bunch of gains or losses from the hurricane. We have some gains or losses from the theft. Maybe insurance that recovered some but not others. That's going to be losses and gains. Okay? We put all of those. That's again what a Hodge Pot is. Remember, Hodge Pot is netting. We net. So we put all of the fire pot gains and losses that come from involuntary conversion from the property that's been held for more than a year. We put it all together. We net them. Now, if the net amount of all the fire pot gains and losses during the year equals a loss, so if it nets out to a loss, the net effect is a loss, then all items are ordinary. So we have ordinary gains, ordinary losses. Ordinary gains, ordinary losses are ordinary. Very important to understand. That's ordinary. But what if it nets out to a gain? If it nets out to a gain, then we move all fire pot gains and losses to the main Hodge Pot. And specifically, you're going to see that we put them right here, if we have it. Okay? You might not have anything in the sub-Hodge Pot. Or if you do have something in the sub-Hodge Pot, it might result in ordinary items, so it doesn't even make it to the main Hodge Pot. So once we do that, once we determine the effect of the sub-Hodge Pot, you now go over to the main Hodge Pot. So again, you always start by asking, do we have anything in the sub-Hodge Pot? So that should be your first part. Again, you should be writing this down in order. Involuntary conversion, we have property, and I told you what type of property qualifies. There's three possibilities, and the property's been held for more than a year. We put all of those gains and losses that qualified in the sub-Hodge Pot, we put them together at the end of the year, and the net effect if it's a loss is everything's ordinary. If it's a gain, everything goes to the main Hodge Pot. So now let's go to the main Hodge Pot. So the first item of the main Hodge Pot is you have to have sale or exchange. You have to have sale or exchange. And again, that's the same definition of sale or exchange we've been talking about. So that's the first requirement. The second is the property. And this one is trade or business real property, which we already discussed. It's the same as what we talked about for capital assets. It's that number 2 item. Or trade or business personal property subject to depreciation or amortization. So these two items, the first two items of the three in the sub-Hodge Pot are the same in the main Hodge Pot. What's the main difference? Well, in the sub-Hodge Pot, it's involuntary conversion, right? Involuntary conversion. In the main Hodge Pot, only sale or exchange. Boom, huge difference. Huge difference there. Depends on how the property was actually converted. Okay, how the event was realized. Was it realized by involuntary conversion or sale or exchange? Amount realized minus adjusted basis. How did it occur? Why are we recording this? Because of the event. That makes the difference between the sub-Hodge Pot and main Hodge Pot. Right there, involuntary conversion versus sale or exchange. That's how you get a general idea of whether something should go in one or the other. So again, if we have sale or exchange, we continue. Then we look at the property. If we have trade or business real property, or trade or business personal property subject to depreciation and amortization, we continue. Okay, so you can have one of those two criteria. The property has to be been held for more than a year. We're seeing the same trend. Again, to get long-term, have to be held for more than a year. Once we have that, we put the items in the main Hodge Pot we put them all in the main Hodge Pot for the year. So we net the following for the year. We net all the main Hodge Pot gains and losses. We net all of them. So if you have a bunch of sales or exchanges that happen during the year of trade or business real property or trade or business personal property subject to depreciation, where the property's been held for more than a year, it goes into the main Hodge Pot. By the way, this is not an electionary provision. This is mandatory. Section 1231 is mandatory. But I'll explain at the end that that's a good thing. It's good because this is taxpayer nirvana. Section 1231 is taxpayer nirvana. And that's actually the title of this video, right? Section 1231 is nirvana because you're going to see it's the best of both worlds for a taxpayer. And I'll explain why at the end. So we net everything from the main Hodge Pot. All main Hodge Pot gains and losses. So let's say that the taxpayer sold some aspect of the business and had a loss. And it was a Section 1231 loss. We put it in the main Hodge Pot end of the year. Also had a gain in the main Hodge Pot. We put it in the main Hodge Pot. We net those items. We also net with those items all the fire pot gains or losses during the year if we had a net gain in the fire pot. Only if we had a net gain. If we had a net loss, we don't have to bring anything over. If we didn't have anything over here, we obviously can't bring anything over. So if we have a net gain, we bring all the items over. What I do is I just bring over the net amount. So you just bring over the positive, just bring over the gain. The gain goes over. You don't have to bring over every respective item. Just the gain. Bring over the gain amount. So if you net all the items in the fire pot and it's a positive $10,000 gain for maybe 6 different items, gains and losses, just bring the $10,000 over. Just bring the gain amount over. Don't bring all 6 gains and losses over. Okay? You don't have to. Save yourself some time. Make this less stressful on you. Less difficult. Okay, once we net those two things, all main Hodge Pot gains and losses during the year, and if there are any, if there's a net gain, right, all fire pot gains and losses. If it's a net gain. If there are any, and it has to be a net gain. We bring the gain amount over, we net. Now, if we net, and the net effect is a loss, then all items are considered ordinary. Everything in the main Hodge Pot is ordinary. And including all the stuff in the fire pot if we brought it over. So if you bring this over, and everything, and it's a net loss, everything is ordinary. Everything in the main Hodge Pot, everything in the sub Hodge Pot are all ordinary. But if we net everything in the main Hodge Pot and it's a gain, then all items in the main Hodge Pot. So that can be all these items if there's a net gain, and all the items in the main Hodge Pot, okay? If it's a gain, they're all long-term capital in nature. Long-term capital. So long-term capital gains and losses. Okay? Long-term capital gains and losses. So there's a special rule for the long-term capital issue. That's the 5-year recapture rule. Just know about this generally. But what it says is this is an anti-abuse rule. And what it basically says, it's a codification of the Arrowsmith Doctrine. You're going to learn more about the Arrowsmith Doctrine when we talk about Section 1245, depreciation recapture. And really what the 5-year recapture rule says is that if you have long-term capital, if you have a net gain in the main Hodge Pot, then, and it results in everything being long-term capital, you have to look at the 5 preceding tax years. And if any preceding tax year had ordinary effect in the main Hodge Pot, okay, had an ordinary effect in the main Hodge Pot, then guess what you have to do? You have to reclassify, recharacterize, recapture. I call it recharacterize. Recapturing is recharacterization, meaning you change it. You rechange it. So you recharacterize the portion of the long-term capital gain this year up to the amount of the 5 preceding years that has not yet been recaptured. So if you had, let's say, you went through the main Hodge Pot and it resulted in a net loss. You had a net loss of $100,000 a year ago, and your business is new. Okay, you're in the 2nd year. In year 2, so year 1, we had a net loss of $100,000 under the main Hodge Pot. It's going to be an ordinary loss, right? Because under the rules, because it's a net loss, or it's a net number in the main Hodge Pot. So guess what? It's going to be ordinary. It's going to be an ordinary loss. Now, that's in year 1 of the business. In year 2, let's say we have a $150,000 net gain in the Section 1231 Hodge Pot. It results in a gain. Okay? If that's the case, then everything in the main Hodge Pot is going to be long-term capital. That's under the general rule. But we have to look at the 5 preceding years. Well, we only have one preceding year because there's only been one other year, year 1, where we had a $100,000 ordinary loss, right, in the main Hodge Pot. So what we have to do in year 2, we have a $150,000 gain, that's capital. We recharacterize that $150,000 long-term capital gain to ordinary up to the amount of the ordinary loss in the previous 5 years. That hasn't been recaptured. So in year 1, we had a $100,000 ordinary loss. So $100,000 of the long-term capital gain in year 2 is ordinary, and $50,000 is going to be considered capital. So the $150,000 long-term capital gain in year 2 gets recharacterized, $100,000 ordinary and $50,000 capital gain. Okay? $100,000 ordinary gain and $50,000 capital gain. That's how the 5-year recapture rule works. Just know that generally, the CPA exam tests that generally. If you need to know more about that, look at some examples. Plenty of examples out there. There's lots of examples about all of Section 1231. I strongly recommend going through a few of those examples because they'll really help you understand how 1231 works. It's very mechanical. This is to help guide you. When you're looking at a problem in front of you, and I really recommend going through this video and then doing a problem and seeing if you can keep track of what's going on. This video is just to keep everything straight. It's to keep everything so you understand the conceptual framework of what's going on. Now, I want to bring attention to the last element I'm going to bring attention to is this is taxpayer nirvana. Section 1231 is nirvana. Nirvana meaning that this is the best of both worlds for the taxpayer. Now, remember that in general, whenever there's a gain, a taxpayer prefers long-term capital gains. And when there's losses, the taxpayer prefers ordinary losses. Well, look at this. If we have a gain in the main Hodge Pot, holding aside the 5-year recapture rule, if we have a gain in the main Hodge Pot, right, everything's treated as long-term capital. It's a net gain. So guess what? That's good. We want long-term capital if we have a gain. If we have a loss, guess what? Everything's treated as ordinary. That's good. When we have losses, we want ordinary. So Section 1231 is probably the most taxpayer-friendly code provision out there in the entire Internal Revenue Code. And that's why whenever you talk to practitioners and academics about Section 1231, 1231 is a great provision for taxpayers. It's something that drives our economy in terms of whenever tax talk talks about, okay, how can we drive the economy? Because a lot of the trader business real property and trader business personal property subject to depreciation and amortization, that makes up a big chunk of our workforce. It makes up a big chunk of assets. It makes up a big chunk of our GDP and how we drive the tax code through economics. This is taxpayer nirvana. It has some, again, when we have gains, we want capital. When we have losses, we want ordinary, and that's what you see here. We have capital gains, but ordinary losses. Capital gains, but ordinary losses. So I hope you enjoyed this video. Watch this as many times as possible. Write it out. Go through the steps. Write it out. And then you might even get to the point where you can do all of this without watching the video. And boom, that's what I want for you. I want you to get to that point you can know this because this is probably one of the most tested topics on the CPA exam, or if you're taking a federal income tax class in accounting school or in law school. 1231 is a big deal, a big hitter. I promise you're going to have a 1231 question on an exam. And going through this video and then going through some examples after this, look on the internet if you can't find it in a book or whatnot. But going through this video and going through the some examples, I promise you're going to ace it. You're going to ace it. So thanks a lot, and I really hope you enjoyed this video.